You might have heard people say the US is printing money to solve its problems. It sounds kind of crazy, right? Like something out of a Monopoly game. But the truth is a bit more complicated than that. The US government doesn't just fire up a printing press when it needs some extra cash. There's a whole system in place, and it involves a powerful institution called the Federal Reserve. This isn't about simply printing more dollar bills. It's about increasing the money supply in the economy, and it's a powerful tool that can have both positive and negative consequences. So, why does the US keep doing this, even with a massive national debt? The answer lies in understanding a complex economic strategy called quantitative easing. Quantitative easing, or QE for short, is a bit of a mouthful. It's basically a fancy way of saying the Federal Reserve is injecting money into the economy by buying up government bonds and other financial assets. Think of it like this. Imagine the economy is a car engine, and the money supply is the oil. When the engine starts sputtering, like during a recession, the Federal Reserve can step in and add more oil, or in this case, money, to get things running smoothly again. QE is designed to lower interest rates, encourage borrowing and spending, and ultimately stimulate economic growth. It's a powerful tool, but it's not without its risks. The Federal Reserve, often called the Fed, is like the central bank of the United States. It's responsible for keeping the economy stable and promoting healthy economic growth. One of the ways it does this is by controlling the money supply through policies like quantitative easing. The Fed has stepped in with QE during times of crisis, like the 2008 financial meltdown and the COVID-19 pandemic. These were moments when the economy was in free fall, and the Fed decided to act aggressively to prevent a complete collapse. By injecting trillions of dollars into the economy, the Fed aimed to prevent a catastrophic depression and provide relief to struggling businesses and individuals. One of the main concerns with printing money, or quantitative easing, is inflation. In simple terms, inflation is when prices for goods and services go up over time. Remember that gallon of milk that used to cost $2? With inflation, it might cost $2.50 a year later. A little bit of inflation is normal and even healthy for a growing economy. But when inflation gets out of control, it can erode the value of your savings and make it difficult to afford basic necessities. Think about it like this. If the government prints too much money, it's like flooding the market with monopoly money. The money itself becomes less valuable, and you need more of it to buy the same things. Hyperinflation is the worst-case scenario when it comes to printing money. This is when inflation spirals out of control and prices skyrocket at an alarming rate. Imagine going to the store one day and a loaf of bread costs $10. Then you go back the next day and it's $20. That's hyperinflation. This kind of economic turmoil can devastate a country, wiping out savings, crippling businesses, and leading to widespread poverty and social unrest. While the United States has never experienced hyperinflation, it's a cautionary tale that illustrates the potential dangers of mismanaging the money supply. The key takeaway here is that while printing money can provide a temporary boost to the economy, it's crucial to strike a delicate balance and avoid the slippery slope of runaway inflation. Section 6. Short-term relief, long-term risks, a delicate balance. So why does the United States keep using quantitative easing if it carries the risk of inflation? This is a question that has puzzled many economists and policymakers alike. The answer lies in the immediate benefits that quantitative easing can provide, especially during times of economic distress. The answer is that it can provide significant short-term benefits, especially during economic crises. When the economy is on the brink of a recession, the Federal Reserve steps in with quantitative easing to inject liquidity into the financial system. By injecting money into the economy, the Fed can help to prevent recessions from turning into depressions. This influx of money can stimulate economic activity by encouraging spending and investment. Quantitative easing can provide a much-needed boost to struggling businesses and prevent mass unemployment. Small businesses, which are often the backbone of the economy, can receive the financial support they need to stay afloat during tough times. It can also lower interest rates, making it cheaper for businesses to borrow money and invest, which can stimulate economic growth. Lower interest rates mean that businesses can take out loans to expand their operations, hire more employees, and invest in new technologies. Additionally, it can boost the stock market, leading to higher stock prices, which can increase consumer confidence and spending. When people see their investments growing, they are more likely to spend money, which further stimulates the economy. However, these short-term benefits come with potential long-term risks, including higher inflation. Inflation can erode the purchasing power of money, making it more expensive to buy goods and services. As we discussed earlier, printing too much money can lead to inflation, which erodes the value of your savings and makes it harder to afford everyday goods. This is a significant concern for individuals on fixed incomes or those with substantial savings. It can also inflate asset prices like stocks and real estate, creating unsustainable bubbles that eventually burst. When these bubbles burst, they can lead to severe economic downturns and financial instability. Lastly, quantitative easing can exacerbate wealth inequality by disproportionately benefiting the wealthy who own assets like stocks and bonds. This can lead to a more divided society, where the rich get richer while the poor struggle to make ends meet. Section 7. The United States dollar, a global currency with big shoes to fill. The United States dollar plays a unique role in the global economy. It is not just a currency but a symbol of economic stability and trust. It's the world's reserve currency, meaning it's held by central banks around the world as a safe haven asset. This status is not easily earned and comes from decades of economic dominance and political stability. This gives the United States a significant advantage, as it can borrow money at lower interest rates and its currency is in high demand. The demand for the dollar means that the U.S. can finance its deficits more easily than other countries. However, this privileged status also comes with responsibilities. The U.S. must ensure that its economic policies do not destabilize the global financial system. When the United States engages in policies like quantitative easing, it can have ripple effects throughout the global economy. Printing more money can lead to inflation, which affects not just the U.S., but economies worldwide. Other countries may be forced to follow suit, even if it's not in their best interest, to avoid their currencies from becoming too strong relative to the dollar. This can lead to a cycle of competitive devaluations, impacting global trade and economic stability. This interconnectedness highlights the importance of the United States acting responsibly and maintaining the stability of the dollar. The world relies on the U.S. to lead by example, ensuring that its financial policies promote global economic health and stability. Section 8. The fragile trust in money, a house of cards? At its core, money is based on trust. This trust is not just a simple belief but a complex social contract that has evolved over centuries. We trust that the pieces of paper in our wallets or the digital numbers in our bank accounts have value because we believe others will accept them in exchange for goods and services. This mutual agreement is what keeps the wheels of commerce turning smoothly. This trust is essential for a functioning economy. Without it, the entire financial system would come to a grinding halt. Imagine a world where no one trusted the value of money. Trade would become nearly impossible. However, when a government prints too much money, it can erode that trust. The delicate balance that holds the economy together can be disrupted, leading to inflation or even hyperinflation. People might start to lose faith in the currency's ability to hold its value, leading to a decline in its purchasing power. This loss of confidence can have far-reaching consequences, affecting everything from savings to investments. This is why hyperinflation can be so devastating. It represents a complete breakdown of trust in the monetary system. When people no longer believe in the value of their money, the economy can spiral into chaos. The United States dollar has enjoyed a long reign as the world's reserve currency, but its future is not guaranteed. The global economy is always in flux, and new challenges can arise at any moment. If the United States continues to print money at unsustainable levels, it could undermine global confidence in the dollar and lead to its eventual decline. The stakes are high and the consequences could be severe, affecting not just the U.S., but economies around the world. Section 9. The future of the dollar, a high-stakes balancing act. The decision to print money through policies like quantitative easing is a complex one with both potential benefits and risks. It's a high-stakes balancing act that requires careful consideration of the short-term needs of the economy and the long-term health of the currency. The United States has been able to avoid the worst-case scenarios of hyperinflation so far, but the risks remain. As the national debt continues to climb and the Fed's balance sheet balloons, it's crucial for policymakers to proceed with caution and maintain a commitment to fiscal responsibility. The future of the United States dollar, and indeed the global economy, depends on it.